Welcome to Realty Bites, conversations on real estate and lifestyle. I'm your host, Evelyn Lopes, and in this episode, we'll be discussing a topic that I'm very excited about, and that is builder pre-construction units, how to invest and how to finance in them. Joining us today is Kyle Cole, a mortgage specialist with BMO, Bank of Montreal, and Kyle has a wealth of experience in the field of real estate investments. Together, we'll be sharing our insights on the benefits and the considerations that you need to be aware of if you're thinking about investing in builder or pre-construction units. And we'll be discussing the financing options available for those who are looking to make these types of investments. As a veteran realtor with over 35 years of experience, I've seen firsthand the potential that real estate investments can offer in terms of building long-term wealth. But I also know that investing in pre-construction units can be a complex process, and it's important to have the right information and guidance so that you can make informed and best decisions for you and your family. In this episode, we'll be discussing everything you need to know about investing in pre-construction units, from the potential benefits to the risks involved and how to mitigate them. Kyle will be sharing his expertise on financing options that are available to investors, including tips on how to secure a mortgage and how to build a strong credit history. Whether you're a seasoned investor or you're just starting out, this podcast is for you. Our goal is to provide you with knowledge and tools that you need to make informed decisions when it comes to investing in pre-construction so that you can achieve your real estate investment goals. So sit back, relax, and join us as we dive into this exciting world of real estate investments. So welcome, Kyle. Thank you again so much for joining us.
Thank you for having me. Very excited to be here.
And how are you doing today?
I'm fantastic. How are you?
I'm doing really well. Seems like the spring season and the market is picking up. I've actually been speaking to several different people lately who are considering purchasing investment pre-construction units. So I thought this would be a perfect conversation for us to have. But before we jump in, maybe you can share a little bit about who you are and what you do.
Of course, yeah. I'm a mobile mortgage specialist all within the GTA area. Primarily, we can do mortgages for anyone across Canada. I've been doing mortgages for about 5 years now, deal with first-time home buyers, investors, multiple properties, first rental properties, kind of going through it all. So helping clients achieve their goals as quick and as efficiently as possible.
Right, excellent. So in terms of pre-construction units, there are lots of benefits that are derived from buying a pre-construction unit. Maybe you can highlight some of those that you've seen.
Absolutely. The two main benefits are the deposit structure. So unlike purchasing your first home where you need to have all the down payment right up front, you can always speak with the builder in terms of their deposit structure to get the property that you want with the deposits over a period of time. So sometimes in certain circumstances, you can actually start to kind of save where you have part of the deposit structure and then save it over that time frame of the agreement between yourself and the builder. The other primary benefit would be for investors specifically. So Bank of Montreal, for example, we offer financing based on the appraised value of the unit at the time of closing versus the purchase price. So you hear it all the time with these pre-construction units when clients buy them, for example, they buy them at a price that's reasonable at the time between yourself and the builder, call it, $500,000. It takes 2, 3, 4 years, depending on delays, sometimes up to 5 and 6 years I've seen, for the property to actually be fully built and ready to close. So over those years, the value definitely goes up over time. And this is where you can benefit from taking out extra equity based on the appraised value. And to kind of use that example, so a client just say planning to put 20% down on a purchase price of $500,000, that means you're looking for a mortgage amount of $400,000. Now, over time, closer to closing, the value of the property might be appraised at, call it $700,000. So this will actually give the client the opportunity to not only just take a mortgage of $400,000, but to take a mortgage based on 80% of the value of the property. So in this case, they could technically get a mortgage of $560,000. So after they pay the builder out for the $400,000 as originally agreed upon, you would actually be left with about $160,000, give or take, to then start your next potential investment right away. So it really helps clients that are looking for those long-term investments and to build multiple properties where they've sat back and relaxed to see the property grow over time and to take out equity right away upon closing.
So then basically they're leveraging that initial agreement of purchase and sale, that initial price, to then buy another property. But a question for you: when the bank is looking at that appraised price or appraised value of the property, it's the appraised value at the time when the property is closing, correct? They can't really pull out the money until that first deal has closed.
Yeah, so once it closes, so that's when the money exchanges hands between the client and the builder and everything's finalized. So generally what we do is we order an appraisal. Once the property, it needs to be about 97% complete, which is generally 2 to 3 weeks before closing. We order the appraisal at that point, and then we can provide financing based on that appraisal report specifically. Another fantastic program that we have is kind of looking at the pre-builds, during COVID time, for example. Clients that bought during COVID time where the value of the property might be here, and they might be worried that it starts to decrease over time potentially. BMO can actually do an appraisal based off of the builder agreement and the specs of the property. So this will give you confirmation that 2 or 3 years down the road, no matter what, BMO will support you based on the value that you purchased it at versus, it potentially going down over time, which is a rare case for pre-constructions.
Right. So then you're actually benefiting both ways. They're appraising it at the time that you purchase it, or 97% finished.
So at the time, if you're looking for just the exact amount based on the builder agreement, 80%, call it loan to value, based on the value agreed upon between you and the builder. You can do an appraisal based off of just the specs and the builder package, and they'll approve it at that point. Or you can wait till closing and we can potentially get more financing based on the appraised value of completion.
Okay, so if somebody's buying their first investment property, would you advise them to have the appraisal done at the time they're submitting their firm offer on the property? So they might go conditional on financing, they might go conditional on the lawyer reviewing the paperwork, which I highly recommend, especially if you're buying a condo. So once they're removing those conditions, is BMO doing the appraisal at that time?
We can if the client wants. Again, it really depends on the type of investor, and regardless, we can do it right away based on the specs, no big deal there. Or we can wait. It really depends on how the client wants to approach the situation. If maybe they're looking to just get that purchase out of the way and not worry about it and just sit on that rental property, or if they want to then take out equity and take out additional to then start another project right away to purchase another property.
Now, if they were doing that, they would have had to have come to you at the very beginning, right? So they can't come now. Like, say they bought the property during COVID and now they're coming to you to get a pre-approval. Are you going to appraise the property on what it's worth today or what it was worth when they bought it?
Yes, it would be based on today's value. So hopefully they got a good deal. And again, with pre-constructions, generally speaking, I haven't run across a situation yet where the value is lower, because based on builder specs and everything, the purchase is generally a fair price to grow over time. But yes, they would have had to come at the very beginning if they were worried about the property potentially going down in value.
Okay. So you also mentioned that buying a pre-approval, the benefit is that your deposit structure can be sort of a little bit now, a little bit, in a couple of months, depending on what the builder is requesting. Now, say a purchaser wants to go in and they want to buy a new build, and say the purchase price is $500,000 and they need to put in their 20%, so $100,000, but they don't have the $100,000 now. But they feel that between now and when the last deposit is due, maybe they'll have the deposit. saved up, maybe they won't. How does BMO or can BMO pre-qualify these individuals, right? Because they qualify them on income, credit, and down payment if they don't have their down payment in place right now?
Yeah, great question. And honestly, it's a case by case basis. So if a client doesn't have it at that exact moment, it might make it a little bit difficult for us to get the pre-approval letter unless they're able to potentially borrow or get a quote unquote gift from someone else. So that's why there's gray area in that type of situation. And it also depends on primarily the builder specifically. So most builders nowadays, they do request you have a pre-approval letter before actually committing to the contract. They don't want deals falling through and having to deal with all that. So nowadays a pre-approval letter is generally needed. So at that point, the down payment will be needed in order for the bank to give that pre-approval letter.
Right. So purchasing new builds can be a rewarding experience, but you also need to be aware of some of the caveats. So some of the caveats are where I've seen people say, I want to buy a new build because I can't afford that house right now. And I'm thinking in 4 years, I'm going to get more money or I'm going to make more money. And I want to buy it today because I just want to get into the market and I'll worry about everything else when the time comes, including getting pre-approved. And that's the one area that sort of scares me. I always think it's important that a buyer always get pre-approved unless they know 100% they're going to be buying it all cash, right? So what happens or what could possibly happen between now and 4 years from now, we don't know, right? We could get a better job. We could lose our job. We could have something come up where we have some savings and it's, we have to use it. So that's just one of the things that I would say to buyers. If you're thinking about buying new build, to get that pre-approval, speak to the mortgage specialist up front so that you're not hit with these hidden things that you were unaware of or what's expected of you. The other thing is in buying new construction, especially condos and that, is to make sure that you know what your exit strategy is from that purchase, right? So you don't want to be just buying it to say, as soon as it closes, I'm going to sell it or flip it, because there's financial implications with that. So there's HST tax, there's capital gains tax on that. So, you've got to keep that in mind. It's not very easy to assign your agreement of purchase and sale if for some reason you can't close on the ending, closing date. Some builders will let you assign, some builders won't let you assign, some builders charge you a huge amount of money to assign. And even if you are able to assign that agreement of purchase and sale, you could potentially, and in most cases, still be held liable if that second buyer doesn't close, because you still have that first agreement. And normally there's a series then of agreements that go into place. You and the builder, you and the second buyer, and then you, the builder, and the second buyer. So again, to make sure you know about all of these different implications, speak to your mortgage specialist, speak to your realtor, and most importantly, speak to your lawyer.
Absolutely. Yes. I think that the lawyer in this process is the main person out of it all, just to make sure that everything is done to a T and everything is done as seamless as possible. They know all the legal aspects of it. Like you mentioned, if you ever want to assign, if you need to get out of it, which can be difficult, they're generally the go-to when it comes to any amendments made to the contract.
Right. And you've got to remember that most of these contracts done by the builder, whether it's a condo building or just even a development, they are written by the builder's lawyers, and they're pretty tight contracts these days. So you want to make sure that you know what you're getting into. It's not the same as a typical residential real estate purchase. It's a long way out. And like I said, there's so many variables that can take place between now and then. It can be a great opportunity, but make sure that you're doing it for the right reason. The other thing too is that I know years ago you would buy a house, it would be worth a good, like a pre-construction, it would be one price. By the time it closes, it would be worth more money. It was always just like a discounted. So now I also say it's important to sort of weigh that out. So you may go to a new build and the builders can ask whatever they want for their units, right? They're putting into consideration that there's some unknown variables for them as well. And especially during COVID, when we saw the price of lumber, triple, the price of workers, go up considerably as well. They're factoring all those things in. And sometimes you may want to say, okay, if I'm looking for an investment property, why am I looking for an investment property 2 or 3 years down the road? Make sure it's the right thing, because sometimes you may look at that purchase you're making today and say you could get a resale that's, a year or two old, pretty comparable, for say 500,000, but the builder is asking 600,000 because of all these unknown variables. So then you may want to, as a buyer, say, is it worth me paying an extra 100,000 to have it close 3 years down the road with all those unvariables? Why am I wanting to close 3 years down the road? Or is it better to buy it today at 500,000 for less money, start renting it out, start getting, your income or whatever, and working on it that way? So new builds can be a good experience, but you also need to be really well aware of some of the caveats in there as well. Is there anything that you can think of that potential buyers who are looking for a mortgage needs to be aware of because they're buying now but closing later on?
It's just those variable factors that you touched upon before is, generally speaking, everyone's financial situation should be getting better over time, whether it's raises at work, promotions, maybe jumping to a new company for a better opportunity. Generally, it does get better and better over time, but sometimes there's life events where it might affect it. So like maybe having a kid, like the cost of daycare and stuff like that is so expensive nowadays that what we're seeing is a lot of people might not be going back to work because it costs more, or at least it's even to go back to work than to put the kid in daycare full time. So those variable factors that could potentially affect you down the road are definitely ones to consider. And yeah, that's the main thing I can think of.
Right. So in terms of the pre-approval from the bank, for example, so say a husband and wife, they're going to buy their first condo. They buy it now. It's supposed to be closed in two years or whatever. And they're both working. But between now and then, like you said, they have a baby and the wife decides to stay home. Does BMO go back and redo the pre-approval process at the time of closing, or are they assuming that they're both still working? How does that work?
Great question. And sometimes it's a case-by-case basis. So sometimes they might go back and say, okay, well, the income is this as of right now, they're approved based off of this. There might be a term and condition that is added in where it says, confirm documents 90 days prior to closing, just to make sure that the situation hasn't changed or gotten worse in that case. But also the best way to think about it is if that's the case and that's the situation, it's also the bank not wanting to put the clients at risk, because now they're in that exact situation where they have a kid. Now there's only one income source versus two income sources. How are they going to be able to keep up with the payments if there's only one income versus two? They don't want to put the client at a negative situation too, where they're putting them in that type of situation where they physically can't afford the mortgage versus, the two versus one income.
Right. And so I think that speaks to the fact that buyers need to know that once they have purchased a home, between the time that they purchase it and the time that they close it, you need to make sure you don't change things like your job. So if it's within you're not going to have your 2 years in your job, don't start changing your job just before it's time to get your forwarding of your financing. Don't go out and put a lot of debt or credit on things like new cars, new appliances, new whatever it is, right? So people say, I just bought a house. Okay, now I'm going to go out and buy all new furniture for it on credit because that affects your ratios, right? The other thing I would say is don't co-sign for anybody else, right? I know we talked about that in a previous podcast that we had together, where you said it's really important that you understand if you're co-signing for someone else, you are equally liable, correct?
Correct, yes.
Mm-hmm. Is there any other things that buyers should be aware of that they shouldn't perhaps do between the time they purchase and the time they close?
No, I think you hit the nail right on the head. Don't just go rack up some debt. Any liabilities, car loans especially, we've noticed that the big uptake in those. And yeah, just don't get yourself into debt between now and closing, and not even just that for the sake of financing, the sake of how the numbers work out in your own budget. You can get approved one day where your payment is X amount, you're comfortable with that payment, but you didn't factor into a car loan, which nowadays are upwards of $600 a month, depending on the type of car. So to factor that into your budget too, just be very, very careful.
Mm-hmm. And when BMO is doing a pre-approval for a purchaser on a new build, how long do they hold the rates?
Yeah, so for new builds specifically, we do offer what's called a builder capped rate program. So essentially how it works is based on the agreement between you and the builder, you have a set closing date, which is, call it 2 years down the road. We can actually hold a rate for up to 3 years, depending on when the closing is. Albeit how it would work though is the rate that we're giving you is going to be higher than current market rates. It kind of just takes into account that, if rates do go up, that you're still going to be locked in at that rate. But what I personally do with my clients is 130 days out from closing. That's where we can renegotiate rates and say, okay, well, we can actually lock you into a rate at this time in the market. If rates have gone down, perfect. We'll get rid of that old rate. We'll get you a new one at current market conditions. If rates have gone up higher than what we got you before for the capped rate program, you can still keep that same rate until you're closing. So it's kind of getting the best of both worlds and making sure that you're well taken care of and you will get the best rate on the market.
Okay, so why wouldn't someone do the builder cap rate, especially if there's someone like me who's very conservative? I would want to know that I'm good. Like if I think the builder's going to close in 2 years and we know they're always late, so you're giving me 3 years, yay. Why wouldn't I go with the cap rate? Yes, I'm going to be paying a little bit higher rate, but I know that 3 years from now, this is my cap. And if I qualify for that and I feel comfortable with those payments, that's good for me. Question is, if the rates go down, like say I'm capped at X amount, and then by the time I close, rates have gone way down, do I have to lock in at that cap rate, or can I just say, okay, thank you for that cap rate, but now I want to go with your new 5-year lower rate or whatever? Can I do that?
Absolutely. That's exactly the whole best of both worlds and covering your own behind, where no matter what, you're going to get the better of the two. So that's why it's really important for timing and to deal with your mortgage specialist, see how long they can keep a rate for, because that exact example is 2 years, you're getting that rate. Just say it's 5.5%. We can guarantee you that no matter what. If rates are 3%, 130 days from closing, we'll scrap that 5.5%, say goodbye. We'll get you that 3% that is at the time, closer to closing, the 130 days out. So just taking advantage of the best of both worlds approach.
Right. And I'm sure that a lot of people looking back, because 2020 is always perfect, right? Vision. Looking back at the last couple of years, they wish that they had done that since rates have increased, right? So again, it's really important to know what your options are, to speak to someone like Kyle who can give you some, information about maybe some bank programs that you might have not otherwise known of, such as this, what is it called? New build cap rate or something?
The builder capped rate program.
Builder cap rate program, so that you're protected either way. And then again, it gives you options. So as we said at the beginning of the podcast, we're going to give you information so that you can make informed decisions, knowing your options. So that was a definitely a golden nugget there. Thank you for sharing that, Kyle. I'm sure a lot of people will be taking advantage of that one.
Always.
Is there anything else you wanted to touch upon on new bills in terms of the qualifications? I'm assuming it's the same as with any purchase, right?
That's correct. Yeah, just keeping your situation the same, if not similar or even better than what it was before, and just making sure that you're secured in your financing. And I'll always go back to it no matter what, budget. Always budgeting and making sure that it's within budget.
Right. Okay. Great. Well, I appreciate you taking your time out again with us, and thanks for joining us. And For our listeners, again, if you found this informative, please subscribe to our podcast. We put a new episode out every Monday, and we'd love to see you on the next episode of Realty Bites, conversations on real estate and lifestyle. I'm Evelyn Lopes, your host, and we'll see you next time.
Thank you, Evelyn.
Thanks, Kyle.